Good morning, everybody. I'm going to give you a quick run through on Midas Gold and our Stibnite Gold Project. We're located in Idaho. We're at the opposite end of the spectrum to the talk you just heard. We're right at in the process of completing a feasibility study and permitting for redevelopment of this site into a large-scale open pit mine. Clicker isn't doing anything. Yeah, there we go. Going to make some forward-looking statements. So this slide summarizes our shareholder base, and I think the key point to take out of this is we have strong support. Barrick's our largest shareholder. Paulson's a major investor. We have M&G out of London, Sun Valley, etc. A very strong institutional shareholder base. Franco bought a royalty. Teck bought a big percentage. And why are all these people investing? It's because of the size, quality, grade, and cost of this asset, production profile of this asset. So what is the asset? We're located in central Idaho. Essentially the geology of Nevada continues up into Idaho, extensional terrain, but much less obvious because of the mountainous terrain and heavy forest cover, so much less well developed. Our site has seen about 1 million ounces of prior production, about half between the 20s and 50s, and half in the 80s and 90s. Idaho is re-emerging as a gold play. It used to be pretty active in the 80s and 90s. A lot of the mines, or all the mines, shut down in the late 90s when gold price went down. But you've seen companies like Integra and Beartrack by Revival Gold being picked up and essentially following the path that we've pioneered to sort of rejuvenate Idaho mining. This is getting out of date now, but it's kind of a good springboard to talk about where we're going. So we did a pre-feasibility study in 2014. It showed production of 340,000 ounces of gold a year over a 12-year life, with potential to push that out to 15 with additional conversion of inferred. There's an antimony byproduct. This is a 20,000 ton a day milling operation, so it's a large-scale operation. Initial capital is about just under $1 billion, and you can see the rate of return and IRR there. And as you see on the right-hand side, very low costs, around $600 an ounce, and below that in the early years. So what's changing from this in the feasibility study, and this is definitely forward-looking statement type of things, is really there's sort of 4 major areas of change. You can see in the top left, the gold price used in that study was $1,350. If you use a 3-year trailing average today, it's going to be lower than that. But in the small type at the bottom, the tax rate when this study was done was 35% in the US. It's now 21%. So I think there's good potential that those two will offset each other. Lower gold price, but much lower tax rate. The capex on the left, is almost certainly going up, and it's sort of really being driven by 2 items. One is the steel tariffs have driven steel costs up in the US by about 20-25%. There's a lot of steel in a plant this big, and so that's putting some pressure on capex. And the other is this study is now 5 years out of date, and you've had a booming US labor economy for that 5-year period, and even 2 or 3% a year, and wage growth compounded over a 5 or 6 year period is going to have a significant impact because labor pervades everything. However, there is potential for significant offset of that increased capital through lower OPEX. And we put out a couple of announcements that talk about why that OPEX is going to go down. But before we get to why the OPEX is going down, you can see where we sit on the global cost curve. Right at the bottom end of that curve, on all-in sustaining cost basis, and we're going to see those costs go down. Another big key factor why we've had a lot of investment interest in the project is geopolitical risk. And this is a chart we borrowed from Northern Star when they bought Pogo. I thought it was a really interesting illustration. So this is the number of 300,000 ounce a year gold mines per country around the world, and then ranked against geopolitical risk ranking. And the interesting thing that stood out on this was there's only 18 mines producing more than 300,000 ounces a year in first world countries. And there's only 5 in the United States. So we'd be the 6th one in the United States and the 19th in the first world. And so it's a pretty rare commodity to control a project of this scale and quality in a good location that doesn't have the geopolitical risk. We do have antimony as a byproduct. It's not a well-known commodity, but it's simplistically very similar to a lot of other commodities that China controls. They produce about 75% of the world's primary production. They have about 90% of the smelting capacity. and it's been declared a critical mineral by the US government. Europe has a similar sort of ranking system, and its primary use is as a flame retardant on a global scale. US has a more diversified use base, but flame retardant is the major use and critical use, and it's used in any synthetic plastic material you don't want to burn: carpets, chairs, insulation around copper wire. So two biggest industries that consume it in the United States are the defense sector and the energy sector, because they both don't want things to burn. So it's a critical mineral from that perspective because of the risk to U.S. supply from China. So why are the operating costs going down? It's really driven by two things. One is the change in the resource. So this chart is a bit of a hybrid. The pies there are the updated resource we put out last year, and the square boxes are the reserve from the PFS. So the reserve has not yet been updated. But the key point on the resource update we did relative to where it was before is we had a fair amount of inferred inside the reserve pits, and under 43-101 you have to use that, you have to treat that as waste. And so it has a negative value. By converting it from inferred to indicated, you make it into ore, so you not only save the negative cost associated with treating it with waste, but you get revenue as well. So we did a bunch of drilling. We basically did it on an NPV basis, so the drilling was focused on the left hand, the Alpine Deposit, which is the first 8 years of production, and you can see there's virtually no inferred left. There's only 5% of the deposit is inferred. There's more drilling to still be done at the other two. I'm pretty confident we'll convert those ounces, but because they're so far out, they have very minimal NPV impact. So converting the inferred, it gives you a lower strip ratio and increases the number of ounces you're going to produce, so you spread costs over a larger number. So obviously that's a significant benefit. The other component of the Alpine Deposit is this is where the mining was happening when the mine shut down in the 1950s. Very high-grade gold and antimony right below the bottom of the pit, but a lot of the data was from that era, and therefore SRK decided not to use it in the pre-feasibility study. So we went in and replaced that data post-pre-feasibility study, and what you see in the third bullet on the bottom left is the gold grade for the entire deposit went up by 6% through that drilling, and the antimony grade went up 22%. That's a little bit misleading because the only drilling we did was in the top half of that deposit. So the reality is the top half of that deposit went up over 10% and the antimony grade went up over 40%. So what does that mean? Well, you've got a higher grade for the same tonnage, therefore your operating costs will go down. So that's one of the contributing factor. I don't have a slide for it, but another contributing factor is we also went all the way to pilot scale metallurgical testing, and we've basically had 5 wins and no losses on that. We've got higher recoveries, lower coarser grinding, which is lower cost, less reagents, and we're going to use on-site limestone, and these blue line or bands on the top right there going into the West End deposit. Those are limestone, and we're going to replace off-site lime with on-site limestone and lime. And we buy $20 to $30 million of lime per year in the PFS for 12 years. So that's cool at $300 million worth of lime in the PFS. And that will go away because we'll be doing it on site. So that's a significant win. So those are the two contributing reasons why OPEX will go down. What's the upside? There's tons of potential. As you can see here, we have hundreds of holes drilled from the 20s through the 90s, and some of our own drilling that indicate multiple potential for new deposits, and we'll be picking that up soon as we get the permits through for development. The last point to make very briefly is on permitting. We're working our way through that. This is an unusual site. It's a brownfield site. It was heavily mined in the 20s through the 50s for the antimony for Second World War and tungsten, and left a substantial legacy of impacts, tailings with high arsenic, antimony, mercury just dumped in the valley without any constraints, cut off fish passage, etc. And we're, as our redevelopment, we're fixing all of those issues. So we'll get fish back upstream for the first time since the 1930s. So the bar on the bottom is where we are in the permitting process. We're sort of more than halfway through. We expect to have a draft EIS out around the end of this year, feasibility study at the same time, and then a final decision by the end of next year, and be able to move into construction for production right after that. So that's where we are, and thanks very much for your attention, and happy to answer any questions as I'm around the rest of the day. Thank you.
Great, thank you, Stephen.